So look at gold, all-time highs with longs. Okay, and we'd we've mentioned this before that we were reaching all-time highs, but like I said, there's nothing to stop it from breaking to new highs. But we are extremely um, over the edge here with long positions. 408,000. You take a look at total positions, 463,000. This is like extremes. And so if you take a look at the euro, you can see the same thing is happening. Okay, the only difference is its total size that is at the extremes here at 432,000. So total size is at 432, which means they can close off longs and continue to build their shorts. Because if you look at shorts, 262, we still have room to all-time highs of 271, and then it can continue going higher. Okay, all-time highs are created by moments where they push previous all-time highs, right? We've seen that in the markets, and that can happen with positioning too. But um, we expect there to be some kind of a reaction, okay? Unless they're going to push gold into territory like we've never seen before. But by studying the past positioning, we know that there is a track record of them pushing price up into aggressive territory and then taking profits and price response. So we've looked at the charts, we've seen what happens specifically with gold. We've looked at in the past what happens when price reaches these all-time highs or aggressive long positions. You know, we had 389,000 here. We saw the drop. 351, we saw the drop. 362, we saw a drop. 381 down here. Now we're up into the 400s. Okay, so can it go a little bit higher? Sure it can, but how much higher are they going to push things? That's the question. That's why there hasn't been any trade signals produced yet on gold. Okay. So our system that produces that locates trade signals, locates them based on price action. Okay. Once price action displays a certain dynamic on the charts, that's when the trade signals get produced. So anybody trying to get in long, could it work out? Sure it could. You know, we have new weekly area of demand here. Could price drop and rally up higher from there? Sure, that's possible. Okay. Would I want to be getting in long when price is already so extreme and long positions are so over leveraged? I would not want to do that. Okay. This is not a trade I'd want to take. So we have that weekly trend line here, right here. Okay. So like I've been mentioning for a long time now, the first thing I'm waiting for is for that weekly trend line to break. If that weekly trend line doesn't break, there's no signals. There's nothing to take to the downside. It's just not a good idea. Now we recently had a monthly area of supply, so let's take a look at the monthly chart. Okay. Okay, so here's what we got here. So we just recently had this monthly area of supply taken out. And that supply being taken out has now produced this new area of demand. Okay. And we have the 3-month distal line sitting right here. Now price is pretty close to that distal line. Pretty close to it. So is it going to break? Is it not? I mean, based on what we have seen in the past with the charts, this supply typically does not break. Okay, if it breaks, something completely different than what typically happens on the charts is going to take place. And if it does break, then this monthly area of demand here will be extremely powerful. And if it does break and it comes up like this and consolidates at these highs, then we can expect profit taking on long positions and potentially a drop to this area of demand, and then I'll be looking to get in long, because then the whole market dynamics will shift. We will no longer have an area of supply holding price down, okay? But that doesn't typically happen on the charts, okay? It just doesn't typically happen. Does it mean it's not going to happen? No. Okay, so let's take a look at this. Let's get some of you involved. Who has their mics and would like to participate in the session? We'll examine this 3-month chart. We'll look at it into a little bit more detail. We'll do a little bit more deeper analysis, not typically what we do in examining the CFTC data, but we'll make it a special episode of the analysis today. Okay, so we have Kelly. Who else would like to participate? Jason,
Okay.
Mike on. How's it going? How's it going?
Hey, Kev.
How's it going, buddy?
Man, so it's going good, Kev.
Good, good. Jasper, how you doing? And Joey, how's it going?
Yeah, good. How are you?
I'm doing well, thanks.
Good.
Okay, so I want to take a look at this 3-month chart. All right, let's go back to examining this here. Okay. Let me take a look and measure this out. I know I've measured it out before, but let's re-examine this. So we have an area that is not very close to being a 50% candle, but what have our classroom sessions showed us, or shown us? When we have a consolidation candle that's a little bit bigger than 50%, that comes before a big drop, we know that these areas here are the ones that are going to be supply, not the area up here, even though that's the beginning of the move. We know that's the area that is supply. Okay, so let's take a look here. So price came down, it removed demand, created supply, and it removed demand here, creating supply here. And then it respected this one. So price was in consolidation. It hit this, it put it in a range, and now it moved up, hit this area of supply, and removed it. Let's apply to you basic members. We're going to talk about something here that we don't talk about usually. Even in level 1, we don't usually talk about it, but we've been examining recently the trend line rules and determining what specifically we should be looking for in determining whether there is a trend line or not. So I'm looking at this area here, okay? And what we're typically looking for is a rally, a base consolidation, a drop, base, and then a rally. So we have that here, drop, base. That is in the lower area of price, so that would be okay. And then we have the break higher, so we have a trend line. So we definitely have an uptrend on the 3-month chart, okay? An uptrend on the 3-month chart, and so when price was in range bound, it was here, and it came down, so came down, hit, came down, took out supply, creating demand. It came down, broke up to the upside. Okay, so uptrend with this supply, yeah. So what typically happens when we have an uptrend is when price hits these areas of supply. See, typically this area here would either be a continuation candle. So you'd have a drop, continuation candle, supply, and then a drop. So what would happen is price would respond from this area of supply, drop to a lower time frame area of demand, and then continue, okay? But so we have to determine whether this here is a continuation drop or is it the beginning of the move. I say it's continuation because we had the beginning of the move here, and then it dropped, didn't give us the candle that we were looking for, but this pause before the big drop, we consider this to be the continuation. So price should respond and drop. at least to a monthly area. So if we take a look at the monthly chart, that area of supply is here. So price has hit it, and we had a reaction, this small one here, and that took us down to, let's see, right down to nothing. Not even on the weekly chart did it bring us down to anything. So it's still reacting from that 3-month area of supply. So what could take place is, see, this is one of those times where I'd like to see where the weekly zone is located on the monthly, and it looks like that weekly zone is located within that area there. Okay. Okay. So what we could see is price dropping to this weekly here. And so this is the first test of that 3-month area of supply. Yeah, it could likely take this out, break the trend line, and then we have the monthly located a little bit lower. So let's get those horizontal rays. And I would do this on your charts too. And you're going to see the importance of why we do this. Monthly demand and monthly demand here. And then we sync it. Sync to all charts, because I want to see that monthly area of demand on the weekly chart. Okay. So now we can see it located right here. Okay. So when I was telling you before that the trade signal was to wait for the weekly ascending trend line to break, and that would produce a supply area that we would be looking for a short signal, that was under the current market dynamic at that time. Things have shifted. When things shift, you have to take what's happening on all the charts into consideration. So here's a weekly chart, and you see where that ascending trend line is. Okay, it's right here. Now I want you to pay attention, because if price consolidates here and then comes down and breaks through, we'll have a weekly area of supply. And price can come down like this. Now what would happen once this weekly area of supply is created and price comes down and hits this monthly demand zone? What kind of dynamic would we be having? We'd have a weekly area of supply just recently being formed, which was great, but what force would be in play?
Monthly.
Monthly. Yeah.
So what's stronger, monthly or weekly?
Well, monthly force up.
Yeah. So now when price comes up to this weekly, we just can't short. We just can't do it. Because what could happen is this could be taken out, price can come up, create a demand here, drop, and then continue higher. So the dynamic has shifted now. So what we could do is we could wait for price to come up here to the weekly area and then show us signs of a reversal from there to the downside. And then we could take advantage of that to the downside, but we can't just short blindly there. So with this weekly or this 3-month area of supply being hit, a couple things can happen. We could see reaction to the downside, taking out weekly demand, weekly ascending trend line taken out, and a push lower to come into contact with this area here on the monthly chart, the monthly demand, and then a continuation to the upside. Or, not likely, but possible, this 3-month area of supply gets taken out. Just boom, push to the upside. And if that happens, then we'll have new 3-month area of demand being formed. At that point, what it could do is just lightly take out that, we don't have a monthly up there, right? No. It can lightly take out that 3-month area of supply. And if you take a look here on the weekly chart, right here is a weekly area of supply sitting just above the distal line of that 3-month area. So if price is to go a little bit higher like that and actually remove that 3-month area of supply, then it could drop from this weekly area of supply. Then we'll have new areas of demand responsible for removing that 3-month distal line, and that will be very, very powerful information. But of course, with the long positions at extremes, we'd be wanting to see some profit taking, and then a drop to demand, and then we'd be looking to get in long and take advantage of the move to the upside. Once they've taken profits on those longs, unloaded, let price consolidate, drop to demand, and then we'll take advantage. And then, you know, we don't have to worry about missing out on a bull run because we'll have the clear signs that they're taking price higher, and we could take advantage of that. Okay, so when I got involved in that in that theme short, was very small position, 1/3%. So I mean that's really not anything big in terms of total size of my investment account. 1/3 is no big deal, but you saw that there was a good argument for a move lower from that area. We had the dollar responding, creating momentum to the upside, momentum shift to the upside. So things were looking good. Positions were at all-time highs. Everything was pretty much aligned for a good retracement down. But because there was no signal, and I knew that we were getting in extremely early, especially with only a 3-month area of supply being hit, and nothing lower. We knew that, you know, it's going to take some time to play out if the drop was indeed going to happen, and it would be way too risky to get in with a full size. But if you scour the internet and see what traders are up to, a lot of traders are being hurt right now, big time, with gold shorts. So, like I posted in last week's report, you know, being a good trader is not just about finding good trades, but also knowing when not to be trading. And so if you don't know that, you know, there's a lot of indicators on the chart saying that price is overextended, but just because it's overextended doesn't mean anything. You know, if you look at a 4-hour chart, you know, yeah, this is overextended, this is overextended, this is overextended, this is overextended, but, you know, on a monthly chart, it doesn't look overextended. This is just a regular 2 long candle move, and you see these all the time on the charts. So putting things into context, you'll realize just because one indicator on one time frame is telling you it's overextended, it doesn't mean anything. You know, overextension is all, you know, a perspective, right? Based on what you're looking at. And if you're too focused on one time frame, you're going to miss what's really happening on the others. So going back to the data, we look at this here and we see, getting back to gold, 408,000. That's crazy. So not good to be buying. We're watching. We'll wait and see what the institutions do because they're telling us what they're doing. They're removing supply areas. You know, one thing that's got me really wondering here is why they are removing this monthly area of supply. Because what have we mentioned before? Okay, I've mentioned this before and I'm going to mention it again. So let's say you have a 3-month area of supply, which is what we have, okay? And nested within that 3-month area of supply, you have a lower time frame area of supply. And it's located, you know, somewhere on the lower portion of that, of the higher time frame area supply. If there are no other areas of supply on the lower time frame within that higher time frame area supply, and this lower time frame area of supply gets removed, it typically, not always, but typically means that the higher time frame area is going to be taken out. So when we look at gold and we see this monthly area of supply here, it's the only one that was located within the 3-month area of supply, okay? Because you could take a look here and we have that trend line It brought us to this area of supply, and then the secondary, which was removed. Here was the demand. Here was the supply that removed that demand. So this area up here was not responsible for breaking a trend line or removing an opposing zone. Okay, so that is not supply. So this supply that was nested at the proximal line of the 3-month area of supply has been removed. So this typically means that higher time frame area will be taken out. So important to know that, because we could see that, and especially with price being so high up here, you know, it's a good sign that it'll be taken out, but it hasn't been taken out. And I've learned through my experience that, you know, we could have price do something like this, where it comes up just about to take it out, stops, reverses, and then starts to break down. As long as that distal line does not get penetrated, that zone is good. So we can't make assumptions of that this zone is going to be taken out just because it's very close. So watching this one, this one's an important one to watch. But I think that, you know, once this gets taken out, consolidates, profit taking on longs, and then price drops, it'll be an excellent time to get in long gold. Just not now. All right, so that is with gold. We take a look at the dollar, and we see that longs have been aggressive over the last couple weeks. Okay, back early February, we had, and beyond that, we had long positions very cooled off. So they weren't really doing much, and we knew that. Okay, remember in previous reports, I was saying that the institutions don't always focus in on, they don't usually focus in on all the assets at the same time. They focus on one, and then once they're done focusing on that one, they move to the next one. And euro and the dollar were two that they were not focusing on for quite some time. I said they're focusing on gold, and that's exactly what they were doing. They were focusing on gold. They were putting their money in purchasing gold. And that's why we weren't seeing anything taking place with the dollar. So for many weeks, and the euro, many weeks, nothing much happening. So over the last 2 weeks, now we see them starting to get aggressive. Now, they also jumped up their shorts from 12 to 22, but this past week they just dropped it back down to 16. But what position I'm focused on here is the long positions, because we have the sentiment used to be somewhat neutral. Now it's turning into bullish. We look at net positions, they are bullish, and we look at the net positions combining both the non-commercials and the commercials, and we can see that it's bullish, and it's been bullish for quite some time. All right, last few weeks, look what's happening here. 26K, 26, 34, 35, 40, 49. So what's the trend here? The trend here is they're building up a long position. Okay, so when you look at the data and you see what they're doing with their positions, they're building a long position. Then you look at the charts, and we still have price in a range. Okay, we have supply here. Okay, let's just close that and open it up again. Okay, so we have supply here. Level 2 students take note of this, okay? Because we've been studying the charts, and we've been doing the homework, and we've been taking a look at what happens with price action when price is in the range. So what happens when price is in the range? Okay, that's what happens when price is in the range. When does that range end? We can't predict, but we know that it's in a range. So that's the first thing that we have to focus on, is what is happening on the higher time frames. And right now we know that it's in a range. Now, when price was reacting from this area of demand here, it was creating a momentum shift on the weekly chart. It produced a momentum shift demand zone, which would have been a good signal to go long if price had retraced up there before this came into contact. So now, just like what we were looking at, what was it with the euro earlier? Let me see. Let me try to get my memory back here. No, it wasn't. Was it with gold where we were saying that, oh yeah, with gold, if price drops into monthly demand, you'll have monthly demand in play with a weekly momentum shift supply. So same thing with the dollar, okay? If price had come, so let me open up this weekly chart here and give you an example. So this is getting into more advanced stuff, but it's important to understand so that you understand the current dynamic of what's taking place. So price was creating this weekly momentum shift. If price came down like this without touching the monthly area supply, this would be a great area to go long, okay? Because what would be happening is a momentum shift would be taking place off of a monthly area of demand. So that's good. But once price hits monthly demand and just goes up and hits monthly supply, you can't assume that this weekly area of demand is going to hold anymore. Because even though the positioning is telling us that they're increasing their longs and it will likely continue, we don't know that for a fact, but likely, monthly is in a range. And that's the most important thing. Nothing else is more important than that. And if monthly is in a range, you know, it's best to buy low in the range, like in areas like this, because we know higher time frame trends are up. So over time, that range should break to the upside, meaning monthly supply should be removed, and then new demand being created, and then eventually a push to the upside. But if you buy here, that's in the middle of the range, right? You know, monthly supply is here, monthly demand is here. When price is dropping and stopping here, you're stopping midway throughout that range. And that's extremely dangerous. So we don't want to be buying midway through the range. We could wait for momentum shifts to take place. It's riskier to do that. I'd rather wait for a momentum shift to take place down here, because at that point, monthly demand will come back and play because this weekly is nested in that monthly. Okay, so the dynamic now is what's taking place on the monthly chart. And we have to understand this can take place. And as that takes place on the monthly chart, they could start accumulating a bigger long position and getting rid of short positions. And we could look for an entry lower here on this range. Okay, so that can take place with the dollar. So let's take a look now and see what we got in terms of oil. Okay, so oil. We look at oil and we see that they were very aggressive, still aggressive long, but not as overly aggressive as they were. They were very cooled off with short positions. Recently, we've seen them becoming a little bit more aggressive, but just this past week, they've dropped positions from 180 to 159. So we take a look at oil and try to determine what's taking place here. So we saw that big drop. The range on the weekly chart broke. Now remember what I was talking to you about ranges. Okay, we had a range here, supply, we had a range here, demand. Price was in between the range. So you see how price drops from high up in the range to low in the range, to high in the range, to low in the range, to high in the range until it breaks. Okay, this is what happens. So this can easily happen with the dollar. This range broke because of this area of supply. So can it go up here and drop? Yes, it can easily do that. If we look at the higher time frames to give us an indication of what's likely going to take place, let's look here at the 6-month chart. Drop, base, okay, trend line's good. and we're in a downtrend, right? Drop, yeah, this should be downtrend like this. So we have a drop, 50% candles, rally, close above, 50% candles. Yeah, that's decent. The drop was massive. And then the slow climb upwards, I think that's good. Emotional, drop past it, downward trend. So we did respond from a 6-month area of demand, came up, hit the descending trend line on the 6 months. So the force is to the downside, pushing down from there on the extreme time frames. All right, so now we look at the 3-month chart and we see as price was responding from that area on the trend line on the 6-month chart, it came down and contacted a 3-month area of demand. That put price and pushed price to the upside. Consolidated, rallied up, stopped, now pushing and testing this area of demand again. Okay, so that is what's taking place on the higher time frames. If we take a look at the monthly, we can see exactly where that 3-month area of demand is located. It's right here. The first test was very deep into that area of demand, rallied up, hit the underside of the ascending trend line. Okay, I was expecting for price to continue going higher, at least up into that monthly area of supply, but it didn't. It hit the underside of the ascending trend line, came back down, tested the area of 3-month here, back up, and now coming back again. So it's looking very weak. Okay, it's looking very weak, and that's pretty much aligned with the US CAD. All right. So yes, higher time frame area of demand is in play, but we don't have a trend to the upside on that chart. So that upward momentum, that upward force that was coming into play from that 3-month area of demand could be played out. It could be done. And so now this weakness here of these bounces and the lack of momentum shifts to the upside being produced on the chart could be an indication of weakness in oil. Okay, and that's, like I said, that's aligned with what we're seeing with the US CAD, so that's a good sign. All right, so let's take a look now. That's oil and the Aussie. So Aussie, this is good for shorting. I like this chart. It's good. The chart dynamics are good. Okay, we look at the charts and we can see that there's room for price to drop. Monthly area supply is in play. New areas of supply are being formed. So this is a perfect chart for shorting. Okay, we already have orders in the markets to take advantage of a move to the downside, but we're waiting for that retracement. Okay, so let's take a look at the positions. If we take a look, we can see that there's been a cycle that they've been going through. Okay, they push price, they push short positions up in the high 90s, then they take profits. They push it in the high 90s and they take profits. Push it in the high 90s, take profits. Push in the 90s and take profits. So they haven't been consistent with holding on to their short positions. And if you look at the charts, you can see exactly why they haven't been consistent in doing that. Because they haven't been, they haven't been pushing price and taking the trend lower. They've created this downward trend now, which we can take advantage of, but they still haven't created a significant trend and held it. Monthly supply is in play now. Price reacted. New weekly area of supply has been created. This is good, but you can see that there's a lack of momentum here. Okay. Now we talk about momentum a lot because when you study charts long enough, you'll see momentum on the charts. You'll just see it with the price action. So you have momentum and then it reverses. You have momentum and then it reverses. You have momentum and then it reverses. You have momentum, reverse, and then it's dying down and then momentum. Okay. So after the moves of momentum, you will typically get retracements. So would like to see this. This would be great. And that could be fueled by profit taking on short positions, because we see that short positions right now are at a level that, based on previous positioning, they've normally taken profits, and we could see, short positions go to as low as the 60s, and right now we're at 85. Okay, so if they're going to continue taking profits on shorts, what do we know happens every time they take profits on short positions? It fuels a move to the upside. So if they start taking profits on shorts, it could fuel this move to the upside, which will eventually potentially push price up here, which is where I'd like to get in short. That's a great spot to get in short. So, and that could be facilitated by the up and down movement of the dollar. Okay, remember the dollar's stuck in between supply and demand in a range. And right now we are at the higher end of that range. Okay, so what happens when price is in the range? Price drops from supply and rallies from demand. So if the dollar is in supply, we could safely expect price is going to drop. So if the dollar drops, likely what will take place is the Aussie will rally. So that is to be expected. So going short here on the Aussie is just suicide, in my opinion. Okay. Can the dollar break out to the upside and take out supply and continue higher? Sure, it can happen. Is it what it will likely happen? No, it's not what will likely happen. And we know this because from studying the charts, we can see what typically takes place. So Aussie short, I think, is good. We look at the US CAD, like I was mentioning, we're seeing some weakness in oil, which can continue. And if we're looking at the positions, we can see that longs have been pretty much not doing much for some time, okay? And shorts have been the more aggressive position that they've held. Now, back in October, when price was dropping, they took shorts to aggressive levels. They took profits on that. Recently, it was a little bit more aggressive as well. And we can look at the charts and see exactly why that was. Let me bring up the US CAD. Okay, so recently price was responding to this weekly area of supply. Okay, and look where it hit on the weekly chart. Exactly at the proximal line. Okay, we have that descending weekly trend line. Price dropped from the weekly area of supply and consolidated there right at the top side of that ascending trend line or descending trend line. Okay, but again, 3-month area of demand hasn't validated yet, but likely to become validated. We can see this weekly area of supply get taken out at some point, and we can see something like that. So watching for that, but US CAD move to the upside is likely going to take place. But again, remember, look at this weekly chart. What do we have there? What kind of trend do we have there? We don't have one. Look at the monthly chart. What kind of trend do we have there? We don't have one. So when markets aren't trending, they are the most difficult times to trade. Okay, if you want to lose money, trade when the markets aren't trending. Okay, and you'll learn. I've learned that lesson 100,000 times, and so I've learned if it's not trending, don't get in. I mean, there are certain times when markets aren't trending that you can time the markets with some degree of accuracy, but there's always some risk involved, especially when you're counting on a move to the upside taking place on the US CAD and you have price in the range with the dollar. If you have a scenario like that, you're looking for trouble if you want to get involved in that market. You know? So it's better if the monthly chart was in an uptrend on the dollar with no obstacles and price was retracing to a monthly area of demand, and the US CAD was like this, then yes, we could be looking for longs, and it would be high probability to be taking trades off of, even this weekly demand zone that we have located here. And I think that if we do get a retracement on the dollar, which could push this down to this weekly area demand, we're waiting for a signal to be produced off of that area. We're not buying blindly, and we've explained this in other sessions. But I think that would be a decent area to get in long. But again, ideally, what we'd want is for there to be a trend intact on the dollar. So knowing this, you have to adjust your risk. So if you're the type of guy or girl that likes to get in with 1% risk on a trade, with these, with these risk factors in play, you don't take the trade with 1% risk. Take it with 0.5%. That's the smarter move, because you have to know the difference between when things are working in your favor, when the charts are in your favor, and when they're not. If you don't know the difference, if you can't spot the risks, you're going to blow up your account. And this is why traders blow up their accounts all the time. This is why there's so many traders underwater right now, because despite what the dollar looks like, despite what the markets look like, despite what's happening in the world, despite what's happening with coronavirus and all this other stuff, despite all that garbage, if you don't know what's taking place on the charts and how to read it and how to correlate what's happening with one and the other, you're not going to know what risks are involved. And things can look overly extended, and the news could be all aligned perfectly to short gold. And if it looks like the perfect opportunity and you get in with the same amount of risk that you would normally take, or start adding to your risk after you've opened up your first position, you're going to see some big losses. So just search around the internet and see what's happening out there with traders and trade signals. And there's some good services out there that have some really decent traders who trade the markets, and you go take a look at how they've been doing this year, and they're down big time. Okay, so, and if you're down 20%, and we're just in the second month of the year, if you wanted to make 20% by the end of the year, you've got to be aiming for 50% now, close to 50%. Okay, if you started with 100,000 and you lost 20%, that's $80,000. If you were aiming to make $120,000 by the end of the year because you're used to making 20%, well, think about it. What is it going to take to get your $80,000 account to $120,000? Okay, that's 50%, right? You need to make $40,000 to make 120. So what was once, all I need to do is make 20% to make $120,000 and I'm good. Now you have to make 50%. And are you capable of that? The vast majority of traders, the vast majority of professional traders, hedge fund managers, and professional institutions cannot make 50%. So you see how quickly the dynamic changes? Your confidence of, I can make 20% a year, that's no problem, can quickly turn into, shoot, I need to make 50. And then, when your mindset is like, damn it, I need to make 50, now you're going to start taking trades with bigger risk. Now you're going to start to think that the market's better than you do, and you're going to take trades when there's no trends, because now you're looking to make that money back. And then before you know it, you're down 40%. Now you only have $60,000 in your account, and now you need to make 100% to make that 120%. And then before you know it, you're bankrupt. So trading is not just about making money. It's about keeping the money that you have, So my account's fine. There hasn't been great trading opportunities. I've gotten involved. I knew the risk factors. I knew what was good, what was not good. I knew, if there was a superb opportunity or not, and I adjusted my risk accordingly. I've been getting in very small, just testing the waters, realizing that there could be a move, so let me just get in there a little bit. But if it doesn't move, I get out and I take a very small loss. I'm still aiming for my 20-30% a year. I don't have to struggle and work back a huge loss. I'm still sitting back. I'm okay. Yes, it's 2 months. Would I like to be up 5-10% right now? Yes. Actually, I could be up more if you know, I would have taken the trade signals that were presented on the charts, and if my analysis had been a little bit more in line with what was taking place. But that's okay. Live and learn. At least my account's not drowning right now. So know your risk. It's just so key. It's not just about trading what you see. It's knowing what risks are involved and when to leverage and when not to. So US CAD looks like some momentum to the upside is building. Looks like longs are slowly increasing. Would I say that this is any kind of momentum of the institutions accumulating a long position? No, I would not say that. It's just beginning. There's only 2 cells here that I have that are in red. So for me, that's not enough. That's not enough. And I want to see more of those shorts being closed off. And I'd like to see price drop into that weekly area of demand and start making bigger moves. US Swiss franc, we have a slow increase in long positions, so that's good. Shorts are still aggressive. And we take a look at the charts. Let's see what we have here with the US Swiss franc. This one's not the greatest chart to trade because, yes, we just recently saw a weekly area of supply get removed, which is good news, producing demand down here. So we could see a retracement, just like on the US CAD, down to demand and then up, possible. No longer a trend, so let me change that downtrend broken and into consolidation like this because that supply has been taken out. So not the greatest chart to trade. I wouldn't want to get involved on this chart because we have monthly supply in play. Demand has not been hit. So monthly supply is still in play. And yes, there's a momentum shift taking place here on the weekly, but let me teach you a very valuable lesson, okay? Because your mind could say, well, the dollar's strong, US CAD's producing new demand, they're adding to their long positions. This looks good. Coming down, we'll buy and we'll take it to the upside. Okay, it could look like that right now, but this could also happen: a drop, consolidate, and then a drop lower. And you'll say to yourself, now why would that happen? You know, they took out weekly supply, yada yada. It should have continued going higher. But what you're not realizing is what's taking place here on the monthly chart. Okay, so the trend was broken to the upside. They created supply, momentum shift supply. It came into control here. Price dropped, fell short of hitting the monthly area of demand, and did this. Up, sure, but this can drop back down and become a consolidation candle. Okay, this green candle here that looks so nice and bullish, it can drop down, become a consolidation candle, and then move lower to demand and then come up. And then later on, you'd say, why would that weekly demand zone not hold? And then you look at the monthly and you're like, oh, momentum shift on the monthly, supply was in play. Typically what happens is supply force comes in, pushes price to the opposing demand. Darn it, I didn't see that coming. Well, yeah, you don't see it until afterwards. But in trading, you have to be able to see things before they happen. You have to know what is possible to happen by looking at the higher time frames. And then that will help you to determine what is likely going to happen on the lower time frame. So this chart I would not touch. Not good. Now we have the euro. Okay, so like I was mentioning before, euro and dollar, they were doing nothing with it for quite some time because they were focusing their attention on gold. All right. So now what do we see? What is becoming more aggressive? Short positions. 212, 215, 239, 242, 255, 266. So you see what's going on here? Now, when we combine non-commercials and commercials and look at their combined exposure, we are seeing a significant increase in shorts, okay? Or in bearishness, I should say. Because if you look at commercials, they're increasing long positions. But we know that the reason why they increase long positions is as a hedge. They're going long when they know it's going to go, when they know that price is going to drop. So when you combine both non-commercial and commercial, we see that, look at this, just in the beginning of January, minus 56 net positions. Then 54, 79, 113, 142, 149. This is strong. This is strong for a continued move to the downside. So we look at the chart. So this is very much supporting a bigger move to the downside. But again, we take a look at the monthly chart. We have to know what context price is in right now. We have supply, we have demand, just like the dollar. Price is stuck in a range. Okay, so we could have this until a breakdown. It's possible. We can have price doing this. So we got to be very careful. Is it, so if price comes up here, I think we have a weekly supply somewhere halfway in the range there, which this one here. Okay. So this would have been a good area to short if the monthly demand hadn't been contacted yet, but it did. So if price comes up here, remember, we're halfway in the range now. This is a great area of supply to take a short. If the dynamics on the charts were different, it would be beautiful. But in this case, once this area of supply gets hit, we'll be halfway in the range. So we got to wait for signals to be produced off of this area of supply. And that's what I will be waiting for. Okay, because I want to get in short the euro. I definitely want to get in short the euro. It's just that I can't get in short blindly here. Because if I do, chances are I'll lose my money. So waiting for additional signals to be produced, or waiting for a signal to be produced, showing us that the institutions want to use this area to accumulate more shorts to break the range on the monthly, that is what I'll be watching for. But it's risky. It's very risky, okay? Because we have monthly in the range. It's a risky trade. So a couple of years ago, I wouldn't have taken a trade like this. But because of studying charts for long enough, I've learned that, you know, considering what's happening with the markets, with gold, with the dollar, and what could likely take place, if that signal gets produced off this weekly area of supply, then I'll be watching for that, and I'll be participating in a short position there. Okay. So we go to the pound. Pound longs are aggressive, and we switch to the chart. Longs are aggressive. That came as price was hitting demand, already tested. This is not a good chart to trade right now. Not good. Okay. Range. Where are we right now? Halfway through. Okay. Upward trend on the weekly, already tested demand. This is not good. I don't want to touch this chart. If you try to trade pound, good luck to you. Okay. Because I'll tell you right now, the odds are against you. I don't care what time frame you're trading, how good you are, how many years experience, everything is working against you. So I would not touch it. US dollar, Japanese yen. So we see that shorts are somewhat aggressive. Longs are not doing much there, but net positions are favoring a bullish move. If we take a look at both non-commercial and commercials, what we can see is that back here in December, they were somewhat aggressive with their longs. They became less so, and then recently in January became more so, and then recently less so, starting to slowly build up, but nothing strong. Okay, so if we take a look at the charts, we look at the US Japanese yen. Let's take a look. So we were expecting this move to the upside. Okay, this breakthrough here and the trend line, right? We looked at all the indications. What was the first indication? Remember what we were saying? When price deeply penetrates a trend line like that, it doesn't produce any type of zone, no consolidation away, likely going to break to the upside. So that happened. Now we have this demand being formed, but that demand zone is a doji candle. We don't like that. Price came up to supply and now dropping. Are we surprised by that? No, we're not. Okay. Look at the monthly chart, okay? So this is a good sign for a potential move to the upside. because the downward trend line and the downward trend is being deeply penetrated. So if price comes up here and then consolidates, we'll have a nice area of demand down here, and that could be the momentum shift required for a bigger push. And this will all be timed with the dollar. Okay, so remember the risks involved. The dollar is consolidating. It's in a range, I should say. So until something significant happens on that chart, we don't know for certain what's going to take place. Again, we can look at the positions, we can look on the lower time frames and try to judge the move that's going to take place by what the institutions are doing. Because remember, everything that happens on the lower time frame helps facilitate a move on the higher time frame, right? Remember I brought up the idea of a person standing in the middle of a room, and there's a door on the north and a door on the south, and you have to determine what door they're going to go to. And the way that you do that is by looking at their behavior in the room. If they take 3 steps towards the north and 3 steps towards, or 6 steps towards the south, and then 6 steps north and 6 steps south, and they're staying in a range, you can't determine what door they're going to open. But if they all of a sudden start to take 9 steps towards the north side and only 6 steps back and then 6 steps forward, then they're starting to show a pattern that they're moving closer towards the north door than they are in moving to the south. And then you can determine likely they're going to move towards the north side door. Okay, but always know the risks involved, because they could just create a new pattern, right? At the beginning, when they were moving six steps in one direction, 6 steps in the other, they were creating one pattern, ranging. When they start moving towards the north side door, they could just be getting really close to that door and reverse and start heading back and create a different dynamic. So in these scenarios, you have to understand there could be a lot of different things taking place. But as the markets progress, as we collect more data, as the charts begin to present more information to us, we'll begin to build up the odds of a certain move taking place. And then when the odds are decent and the positions are good and the dynamics are good and the signals get produced, then we can get involved. And that could be March, that could be April, that could be May, okay? But the key is, don't let yourself get upset. Don't let yourself run out of patience. Do not run out of patience, okay? Because if you want to run out of patience, then you could draw down your account, like I was mentioning, and you could need 100% return come March or April just to get to your target. And that will never happen. In fact, what you'll do is you'll just blow up your account because you'll be so stressed out about having to make 100%. So I'd much rather do nothing January, February, March, April, even May, June. I don't care. I don't care how long it takes. But when the odds are in my favor and then the markets are clear and you're like, wow, now things are very clear. We don't have this range bound and consolidations everywhere. We're having really good really nicely formed trends. We have new areas of demand and supply to take trades off of, and then you pile in. That's when you pile in. Theme trades, trade signals, boom, 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 boom. You could make, you've seen it. You've seen me do it before. You can make 20% in a couple months, okay? So that 20% target, you could reach it by the summertime. And then who knows? August, September, October, maybe October, November, December gives us new opportunities. You could be up 30%, 40%, even higher than that. But this is how it is. We're on the market's time frame, not ours. Just because you want to make money now, it doesn't matter if that's what you want. The market doesn't care. It's all about waiting for the market to tell us the timing and when things are likely going to move, when the momentum is back into the markets and there's no obstacles in the way, then we could take advantage. And when we take advantage, it's going to be beautiful and it's going to be stress-free because we'll be taking trades off of really well positioned zones within trends with momentum. The institutions getting involved, and we'll get into our trades and they'll just work and we'll be like, whew, that was stress-free. So it'll take time. It'll take time. Just be patient. So let's take a look at the Kiwi So not much here. Shorts are more aggressive than longs. And if you take a look at the chart, remember we were looking at that monthly trend line. The monthly momentum was shifting to the upside. But what did we notice? Once again, we will talk about this always. When a trend line becomes deeply penetrated like this, it typically invalidates the trend line. Okay, so that's what we're seeing now. No zone here, no zone here. Okay, it's invalidating the trend line. So what we do have again is no trend. Well, downtrend is still holding because the trend line hasn't been officially been broken, but it's invalidating this trend line because of this deep penetration. And what do we have? Demand here, supply here. So what can happen? This can happen easily. So again, nothing decent. Look at the weekly chart. What a mess. Okay? What a mess. The last trend we had was in a downtrend like this. It's since broke that trend. We have demand here taken out, demand here taken out, supply, new supply, supply. This can be taken out. It can go up here. It can drop. It can come here. It can. Anything can happen with this. So I'm not touching this. I'm not touching the Kiwi. The ones of interest for me is gold, dollar, euro, Aussie, US CAD, and US dollar, Japanese yen. Those are the ones. So we'll quickly just look at the positions one more time. So dollar, not favoring anything, just slightly bullish. Aussie, shorts, but they could continue on with this cycle of profit taking on shorts, which will fuel a move to the upside, but I think odds are we'll see a bigger move to the downside. US CAD, not long enough for me. US Swiss, stay away. Euro looks good for a short, but shorting at these lows is no good. Pound, leave it alone. US dollar, Japanese yen, I'd like to see more longs being built. Kiwi, stay away. Gold, over leveraged on longs. It's got to break. It's got to drop. Is it going to take out supply first or supply going to hold? That's the big question. So we'll wait and see. Oil, longs are the more aggressive position, but we're seeing signs of weakness on the chart. So I wouldn't touch it as how it is right now. All right, ladies and gents. So that is your breakdown. Do you have any questions before I let you guys go?
All good, thanks, Kev.
No questions,
Yeah.
Kev.
Everything good, Jason?
Yeah, sure, yeah.
Yeah.
Need to reread the report and get everything in perspective.
Yeah. So you know what to look for, you know what to wait for. There could be some good opportunities, but it's just about being patient. So let's stay more focused on our classroom sessions, on the many sessions that we've already done, journaling, reviewing. So let's stay focused on that. When the opportunities exist in the markets, then we'll focus our attention back on getting involved in the markets. All right, guys. Thanks for coming out. Enjoyed, and I will edit the video and post it online within the day.
Okay,
Cool.
Kev.
Thanks,
Okay.
Kev.
Okay,
Thanks,
bye.
everybody. Enjoy your
Cheers,
day.
Kev. Bye, mate.
You too.
Bye. Cheers.